Welcome back to our monthly market commentary series for the month of June. I'm Nik Schuurmans, partner and wealth advisor at Waverly Advisors. As you can see, the title of this month's commentary is Price to Perfection. There's a lot of euphoria. Back into the AI trade, markets have been a bit choppy, but since the March low, they've ascended higher, and a lot of it is concentrated in the AI complex. And I know we talk about this a lot, but this is the market now. If you caught my market commentary last month, something like 55 to 60% of the S&P 500 is tied up in the AI trade. So semiconductors, the infrastructure, the picks and shovels, the data centers, energy, water, all of it is tied up in one theme. And what worries us is the positive trends go out 10 plus years. And a lot of these investors are baking in to these lofty prices for these stocks, these rosy assumptions on revenue growth and earnings growth, that it's going to continue uninterrupted. And I think if there's anything that you can learn from history is that breakthroughs in technology are not black and white. They're not clean. There's winners and losers. Our concern right now is everything is trading as if it's a winner. Also, on the investment sentiment side, a lot of investors are touting their gains online. We're talking with people that aren't usually risky investors that want to get more aggressive. We're talking with folks that are usually very conservative fixed income investors that want to dive into the AI trade and IPOs and all of these things. And it's just something as old as time, where as markets go higher, people want to chase, people want to get more aggressive. And that's often the worst time to get over your skis, especially if you're retired or about to retire, or you're just not being true to your investment personality. So our job is to be a realist. We're not bearish, we're not bullish, we're not pessimistic, we're not optimistic. Our job is to call it like we see it based on our decades of experience. So I hope you enjoy this commentary. Let's get into the slides. As we often do, we look at the intra-month performance, in this case June. We're not quite to the end of June, given the 4th of July holiday. We've had to record this a bit early. I'll just go through some of these asset classes that matter to our clients from bottom to top. The green is gold. Gold's had a pretty wicked ride over the past, call it 6 months. It sold off in January. It sold off when the war broke out, which confounded a lot of folks. And it's down about 9% this month. And a lot of that has to do with the interest rate expectation shift from cuts to hikes. Of course, gold does not pay any income when rates stay higher. When rates increase, gold's competing with other asset classes, and the bond markets, for example, you can get 4% on a 1-year treasury. That could be a decent trade. And then also, there's this narrative out there that a lot of Gulf states, Russia included, have been selling gold to finance their war budgets, their war machine. So some say that's going to flip, and a lot of central banks, global central banks, are planning to buy gold. That remains to be seen, but certainly gold can move without rhyme or reason. S&P 500 and NDX, so that's the purple and blue boxes. Again, this is very similar because the top 10 holdings for the S&P and the Nasdaq are exactly the same. So again, the S&P 500 is technically a basket of 500 companies, but it's heavily influenced by 10 to 12 tech and AI names. And you can see it's moving very closely with the tech index, down about 2.5% on the month. Certainly not catastrophic, but there are some signs. Those tech stocks are starting to move quite aggressively. The Mag 7 is losing its luster a bit. So we'll continue to watch those names, again, as they explain about 40% of these indexes. Emerging markets and foreign stocks, that's EEM in the blue and EFA in the brown, hanging right in there. Certainly EEM has a heavy weight in South Korean semiconductor names. And if you caught our podcast last month, or maybe it was this month, we talked how Korean retirees are cashing out life insurance policies. They're taking on margin. They're speculating. They're getting over their skis on risks. And this morning, the Korean market was down about 10%. So some of these softer side things like human behavior and margin debt can be a precursor to a more difficult market environment. Timing is fleeting, but anytime you see people doing outlandish things and speculating in a handful of companies, it's usually time to pause and reset and make sure that you understand how much risk that you're taking. On the positive side, RSP, that's an equal weighted index. That's something that we introduced this year for many of our clients. It's simply exposure to US large caps, but rather than owning a huge amount, 40 to 50% in a handful of names, this equally owns all 500 companies in the S&P 500. So just a less concentrated bet in some of these market cap weighted indexes where a handful of companies explain 95% of the index's movement. And then VNQ, this is real estate or REITs. This is something that we've liked for a while. We've been talking about with clients. It's a tangible asset. You can touch it, pays income. It's out of favor. So that's had a pretty good run this year. And then RTY, small cap stocks, which are very cheap relative to US large caps. They've had a nice little run this year so far. So all in all, not a horrendous month, but certainly, depending on who you talk to, there's some cracks in the AI trade, the froth, the math is becoming fuzzy for some people as these rosy projections run out for the next 10 plus years. This graph is from Apollo. AI is leading. So this is essentially the market cap change, so the value of the underlying companies and how they've changed over the course of 2026. So the orange line, or the orange bars here on the right, and this moves from left to right, so January 26 to June 26. Again, change in market cap since January 1st. The orange bars going up are the S&P AI companies. And then the blue line, these blue bars, is the rest of the S&P. So if you aggregate the S&P AI names in the orange, strip those out of the broader index, that's what's left over in the blue lines. And the S&P's up about 7 or 8% as of this recording, but much of it has been concentrated in the AI names. Everything else, every other sector outside of energy has left a lot to be desired. Now, in a healthy bull market, you would want to see breadth, meaning every sector or multiple sectors partaking in the upswing. Right now, it's very narrow leadership, which is fine when it's going up, but narrow leadership can also swing the other way and work against you. So if the AI trade unwinds, the index could be in for some pain. There's been a lot of talk about higher rates lately, and this has shifted coming into 2026. The expectation was for lower rates or rate cuts. That has flipped as inflation is spiking back up. Inflation's been very sticky. Of course, energy prices, oil prices going up certainly hasn't helped. But the Fed is in a really odd position. Not only is it going through a leadership change, and the leadership change wants to create a different type of Fed. They're going to update some of the internal models in which they use to interpret inflation. They're changing the way that they communicate with the general public. They're not going to give forward guidance as much as they did post-financial crisis, which is really post-financial crisis really changed the way the Fed communicated with the investing public. They tended to overshare, and that's carried on the last 18 years. And the current Fed chairman is saying maybe that's not the best thing, because what happens is markets are trying to front run what the Fed is saying, and they tend to overshoot and make markets a little more volatile. So it'll be interesting to see how the transition affects investors. As I shared last week in my blog post, Fed chairs, a change in Fed chair tends to introduce market disruption, and the average drawdown is about 12%. Certainly this time could be different, but if you followed us, you know that we're very interested in history, and that's just one data point to consider. Fed chair transitions tend to introduce a modest pullback of 12% going back over the past 50 or 60 years. But back to rate expectations. So this is a chart of Fed funds rate in December of 2026. So the Fed funds rate level at the end of the year. The current target rate or current Fed funds rate is between 3.5 and 3.75%. You can see that the current target rate at the top of the graph. And then the rest of these bars are the percentages or the likelihood that rates will be at these various levels. And you see target rate in basis points at the bottom of these blue bar charts. So going from left to right, you can see the 15% probability that rates will maintain at their current level. So you see 15% on the left bar. At the bottom, that's the current rate level. Now in the middle, you see 37.6 and 33.3. That's a quarter point higher. At 37.6, you see the target rate 3.75 to 4, or a half a percentage higher, 4.0 and 4.25%. Okay, so there's about a, 70% chance or probability that investors are pricing in rates will be at least 0.25 to 0.5 higher than they are now. And if you want to even look at kind of an outlier, 12.5%, rates will be almost a full 1% higher. So when you take all that together, there's around an 83% chance rates will be higher. And this isn't some guess. This is smart investors voting with their capital on where they think rates will be at the end of the year. So quite a bit of difference versus where rates were being priced at the start of the year. I'm not going to speculate on what this means for markets. Historically, higher rates haven't been a death knell for stocks. Where I would look would be the fixed income market. So you certainly wouldn't want to be reaching for duration or reaching for interest rate risk at this point, so buying like 30 or 40-year bonds. So we're quite mindful of our interest rate exposure. A lot of our bond exposure is into 1 to 3 year space. You know, we want to be flexible. Most of our clients are retired or about to retire. When you invest on the short end of the yield curve, call it 1 to 3 years, you're getting around 4%, and I'm using that as a general baseline, so don't hold me to that. But you're getting a decent amount of yield, but you have optionality, you have flexibility. If and when rates do move higher, you invest in a shorter term bond, those bonds mature, you can reinvest in higher rates. So again, it all depends on the game that you're playing. For folks that are retired, having optionality is a good thing, which is why we like the front end of the yield curve. The other thing I'll say, where this could come into play, a lot of these AI companies are spending mind-numbing amounts on capital expenditures. I'm talking billions year in and year out, trillions over a multi-year cycle. The cost of capital is very important. If the cost of capital, the cost of debt, the cost of equity is going up at the very time that they need to raise capital, that could be a headwind. So that's something to look out for. I don't know how this AI game plays out. Anyone that says that they do is full of it. The range of outcomes is quite wide, but certainly the cost of capital at the time these companies are raising potentially trillions of dollars is a big deal. Margin debt. So margin debt is something that we talked about with South Korean investors borrowing to invest money. That's what margin is. You're borrowing money to invest in risky assets. There could be a time and a place for that, near maybe a cycle high, chasing performance, reaching outside yourself might not be the time. And there's a clear pattern with margin debt. So this purple line with the red square at the top right shows real margin debt growth since 1997. And then the teal line is real S&P growth during that same period of time. And these gray lines are recessions. So these gray bars, you see like 2000, 2008, 2021, or 2020. But what I'm interested in here is when margin peaks, when there's a cycle peak in margin, usually that precedes a market sell-off. So as investors get more excited about stock investing, as they borrow money to crowd into markets when they're performing well, that's usually a flashing red light. And that's what's happening now. US investors are borrowing money to crowd into AI names, to crowd into US large caps, to chase performance. You can see every time this happens, 2000, 2007, 2021. What follows is often a difficult market environment. You can see that in the teal, the sell-off the sell-off post-margin peak. Sell-off post-margin peak in 2009. The same thing happened in 2021. Is that going to happen in 2026? I don't know, but history often rhymes. And again, this is another sentiment, soft data point that gives us pause. Crowded tech. So it's not a mystery where this money is going. It's not a mystery where retail investors are crowding into. So this is essentially inflows to tech stocks in 2026. And this is an annualized run rate. So tech fund flows. And you can see tech has been in vogue the last decade or so, but investors are really crowding into and allocating to the tech space as it's one of the best performing spaces in 2026. So margin, massive tech inflows. It's not a mystery where this money is going. These are very much known trades. This is not a mystery. You can talk to pretty much every investor. We talk to a lot of prospective clients. Most folks, I've said this in the past, are way over allocated to tech. They're taking a boatload of risk. Most don't know it. This gives us, again, pause or cause for concern. And just one last comment. Know that we own tech. We want to own tech, but we don't want to get over our skis. So we're very mindful of position sizing, what percentage tech and AI is as a percentage of our overall asset allocations. So I would very much encourage people to kick the tires on risk, understand risk management, understand drawdown, understand range of potential outcomes. It always kind of puzzles me that most folks wait for a 20% correction and then come back and say, okay, what changes should I make, or what should I do now? The time to talk about risk management is when markets are ascending higher, investing seems easy, and everyone's talking about how easy investing is. That's when you talk about risk management, not after a 20% correction. This is probably the most alarming chart. It's also my favorite chart, where this is essentially a sorted graph of price to sales ratio, okay? So the higher the price to sales ratio, the more expensive an asset class, a stock, a sector is. And this just breaks down the S&P by what percent is trading at various price to sales ratios. So starting on the bottom left, a price to sales ratio of less than 1 would be very cheap. This would be potentially a very attractive or extremely out of favor section of the S&P 500. And you can see roughly 3.2% is trading at a price to sales ratio of under 1. And you can move from left to right to see where various percentages of the S&P are currently trading from a price to sales ratio standpoint. What is alarming is 51% of the S&P 500 is trading at a price to sales ratio of over 10. A lot has to go right to achieve a positive return with 51% of the S&P 500 trading at a price to sales ratio over 10. Revenue needs to grow significantly. Margins need to maintain or expand. And somehow you wouldn't see a multiple contraction in areas that are trading at over 10 of price to sales ratio. So a lot has to go right over the course of a decade. History is not on your side in this equation. There are exceptions, but when we go back over 80 years of data, when stocks or industries or indexes are trading at over 10 times sales, which is very rare, future returns are often negative. The odds are stacked against you. Now, this could flip the other way. This could be a revolutionary technology. The productivity gains could outrace this. We could grow into this number, but again, we're students of history, we're students of markets, and at these levels, Much has to go right. And the thing about technology is it changes quite aggressively. It changes quite quickly. OpenAI, Anthropic didn't exist a couple years ago, so it's tough to predict where this goes. Also, something that not a lot of people talk about, there's very much a human component with AI. There's some things showing up that are impossible to model. It's impossible to model changes in human behavior, and I'll give you a few examples. A lot of communities are pushing back on data centers. A lot of governments are saying, where's the water going to come from to cool these data centers? Young people, there's an emerging pool of young people that really dislike AI, that really dislike a technology that is making their job prospects dim. So you can't understate the human component to all of this. It's easy to point and click on an Excel spreadsheet and extrapolate current trends well out into the future, but I can't understate the impact of the human component, and there could be unintended consequences as AI gains steam and disrupts the social contract, changes the job market. So I'll just leave it there. But the moral of the story is it's really hard to achieve some of the rosy projections that you've seen trading at these lofty levels. Peak oil. So there's been a lot of talk about oil during this geopolitical conflict. And I stumbled across this chart and I really liked it. So this shows the date in red where the price of crude oil peaked during every major oil price surge since 1970. And there's a clear pattern, and not a lot of people are talking about this, but this goes, again, back to 1970 through 2026. Oil peaked in this cycle, you can see in the top right, on 5/26, so May of 2026. When oil finally peaks, you can see that usually marks a period where the equity market, measured by the S&P, experiences a bit of a sell-off. So, a lot of folks are asking what could cause the next sell-off, and I think rates, the cost of capital, euphoria around the AI trade, oil price stress, all of these things have historically helped push a frothy market over the edge. Again, I'm not saying this is going to happen, but a clear pattern emerges when you get these peaks in oil. That often signals some market difficulty over the next, call it 3 to 12 months. So we don't mean to be bearers of bad news. We're just, again, our job is to call it like we see it. And I think our asset allocation reflects what I've presented here and what we're doing from a risk management standpoint. Kind of the counter argument to all of this is earnings have been really good. Stock prices tend to follow earnings, and earnings growth has been robust. It's been one of the best periods for earnings growth in history. And these things can run longer than most people expect. But if I have a message, it's the time to think about risk management is right now. You have to understand what you own. You have to understand drawdown, how your portfolio could react if we get a 10% sell-off, if we get a 20% sell-off. I see so many people having no clue in what they own, and when you kick the tires on risk, they're often taking a lot more risk than they set out to, which is fine if you're in your early career or mid-career. It could be catastrophic if you're retired or about to retire and need to live off your portfolio. So if you have a question on how we look at risk management, of how we build diversified risk-aware portfolios, shoot us a note at lakeoswego@waverlyadvisors.com. It should be on the screen. Thanks for watching, thanks for listening, and we'll see you next month.